Hi, I'm Erik Ogard, CIO of the Wealth Plan Group. Today, I'd like to talk about uncertainty and investing and the combination of uncertain markets, uncertain economy, uncertain outcomes, uncertainty with respect to stock fundamentals, uncertainty with respect to interest rates. There's a lot of uncertainty out there, and managing that uncertainty is paramount in the investment management equation. But it's quite something that's out of our control, so all we can do is try to design things that can be resilient in periods of heightened uncertainty. And before I sort of get into the nuts and bolts of uncertainty and the tools available to manage it in markets, I think it's really helpful to start with a story to make a point. Years ago, when I was on the pension consulting side of the business, we had a medium to large size window manufacturer who was a client of ours. And we had a meeting with the investment committee. So the CEO, the CFO, and a few outsiders, board members were present. One of the board members was asking about our outcomes within the fund that I was managing for the pension. And I made the comment, we're kind of aiming to be right 54% of the time, and that's really a stretch goal. And one of the committee members said, 54%? That's a flunk. And this guy happened to be kind of a data scientist, a data guy by training. And he clearly didn't understand the reality of capital markets, which are stochastic systems, meaning that there's uncertainty. The capital markets actually share a lot in common with gambling markets or prediction markets. Many don't like the association between gambling and investing, but the reality is they have a similar stochastic base. And so this guy that had said this to me, wait a minute, 54% is a flunk. I said, just for some clarity here, let me try to contextualize this. What percentage of the windows do you guys throw out in the manufacturing process? And he proudly said, we're Six Sigma, which means 1 in 10,000 doesn't meet standards and has to be thrown out. If you were an investor and one in every 10,000 investment decisions didn't work out, in other words, you were right Six Sigma, you would literally own the world. Like, even the world's greatest hedge fund, medallion fund, managed by the late, great Jim Simons, couldn't be right at such a level in the face of stochastic outcomes. So this is, this was really helpful for my understanding, to understand that this guy felt like 54% was a flunk, and they were manufacturing windows at a 99.9999% accuracy rate. We just don't get that in investing. And trying to describe what we felt was our edge at 54% and how that was very good, I made an analogy with Vegas. And, again, it's probably not considered by many to be an appropriate comparison, but they do share a stochastic reality. So I went on to explain that Las Vegas, the casinos, have a 52% edge. And if you think that's not much, the entirety of Las Vegas, all of the buildings, hotels, casinos, event centers, all of that has been built with a 52% edge. So at scale and with large numbers, 52% is all you need to have tremendous success in financial systems. So saying our goal was to be, right in any discrete period 54% of the time. So, that would be, for us, it was calendar years or quarters. Trying to win 54% of quarters would pile up to a pretty good annual advantage. And of course, it does depend upon magnitude. But this idea really gets to the heart of two different concepts. Stochastic, we've talked about, which is uncertainty, and deterministic, which is a way of saying known in advance. And if you're right at Six Sigma, that's pretty much known in advance. And so there's a lot about stochastic outcomes that's an unpleasant experience for human beings. We kind of crave deterministic outcomes. You know, if you think about the world in its natural state, its wild state, the threats to life and limb and a thriving life from nature itself are always present. And so all the things we've done as a species to reduce chaos, reduce uncertainty, and increase predictability is a part of our DNA. It's a part of our wiring as a species. We seek deterministic outcomes, calm, not chaos, not uncertainty. We want certainty and calm, not chaos and uncertainty. So that's what we're striving for. And then we approach these capital markets, which are stochastic. We have developed many, many tools to help us manage the inherent uncertainty of stochastic systems. So not only are markets stochastic, but when we introduce an active investment management strategy on top of a stochastic system, we're introducing a stochastic system and putting it on top of a stochastic system. So additional uncertainty on something that is in itself inherently uncertain. So the setup here is for, especially if one brings a deterministic view that 54% is a flunk, people can have a mismatch between the reality of markets and what we're trying to do with investing and what they actually get. And if they're kind of wired toward Six Sigma, they may not be appropriate almost for any kind of investment other than a money market fund. And even with money market, you run the risk of breaking the buck. So there's almost nowhere to hide when it comes to placing money into investments. There's always uncertainty. So this week's note, I actually delve into a little bit of the things that human beings have created in the financial industry to help us reduce uncertainty and to manage uncertainty. Things like the capital asset pricing model developed in the 1950s, the Black-Scholes option pricing models to help make sense of the derivative markets and pricing derivatives and all the Greek mathematics that go along with pricing derivatives. Factor assessment, so-called arbitrage price theory, factor models. All of these things are designed, securitization, where we actually create better underlying liquidity than we can get from something in its non-securitized state. So we've made many, many inroads to try to help manage liquidity and outcomes and risk, and we have mean variance optimization models that help us build portfolios that will be more durable and stand up to maybe some of the negative surprises. But at the end of the day, after we do all of our work to help manage portfolios and manage uncertainty and create outcomes that we can live with, there's things that are completely uncertain and not knowable in advance. Things like wars, financial crises, elements of fraud in markets, like many things that are just outside of our ability to manage. And then on top of that, you know, not all people feel the same about risks. They have different needs and circumstances, different levels of income, different levels of saving, but they also just have inherent wiring that tells them one thing is not acceptable to them, which might be totally acceptable to another person. And that's what we call investor utility. So we have tools to help us find utility, we have tools to manage the risk, but at the end of the day, the uncertainty that come from the things that may crop up, wars, skirmishes, trade wars, we don't know how the government's going to respond either, and we don't know how markets will respond. Sometimes it seems like an event comes along and markets are fine. Other times an event comes along and there's a big freak out. So the things you can do are, one, assess your risk, hold a portfolio that is consistent with your risk, and we also have embedded in our investment strategies are these ideas that you need to diversify. And you need to diversify by asset class, by type of security held, by individual money managers who may think about the world differently, so they process information differently, multiple securities across multiple sectors. All of these things allow us to diversify so that if we do get negative surprises, they don't sink the whole ship and we're not so concentrated that one event can take us out. So we try to build these very diversified, durable portfolios, knowing each person's risk. And, you know, at the end of the day, no matter what, we try to build something durable, but some bad stuff can happen and you can have a bad outcome. So in addition to all these things, we think dollar cost averaging over time, if you're still saving for retirement, is a great move because you can smooth out the effect of the events on your portfolio. But you may find that you need to save more, spend less, retire later, take more risk. Whatever the case may be, you may have to make a midstream adjustment if one of those uncertain things happen. And we don't like that uncertainty as human beings. We're wired to not like it. But if it happens, the point is, think about it in advance and know what you might be able to do to change the trajectory of your portfolio to get you to the end point of still not running out of money. That's, you know, really the biggest risk investors face is in retirement, they run out of money. And so everything we do in terms of imparting advice and managing portfolios is designed to help people not run out of money and to live within a level that is consistent with their goals and objectives, and to be able to sleep at night so that they're not worried about these things. So if you'd like to have any element of a conversation with us, either about risk or diversifying or making a plan, we'd be happy to do that. Thanks for your time, and here's looking out for what will be, no doubt, more uncertain events in the future. Thank you very much.